$26,000 a year, and she has medical benefits and a retirement package. Okay. Now, so if she's getting paid twice a month, then her gross pay is $26,000 divided by 24 is $1,083 a month. And you can see that in kind of the middle lower box in red. Now, how does she go from $1,083 to her net pay? Well, the first thing that happens here is the federal government will take out what they call withholding, FITC, federal income tax. And now what is that? That's a prepayment of your taxes. So you need to have 90% of your taxes withheld during the year, or you pay a penalty. So you pay an interest rate, and it's fairly low interest rate these days on the unpaid or the difference in taxes. So most people in your situation will have either 0 or 1 dependent when you fill out your W-2 form. Okay, so the lower the number of dependents, the higher your take-home pay will be. So it doesn't affect your ultimate tax liability. It's whether you want to pay for it during the year or whether you want to pay for it in a lump sum at the end of the year. But again, you need to have about 90% of your ultimate liability withheld during the year. Okay? And that's the purpose of tax withholding. The state does the same thing. So the state takes out, they have tables and they take out a percentage of your pay as prepayment of state income taxes. So you see here that she had $122 taken out for federal and $42 taken out for state. Okay. There are other deductions from her pay here. So the first one is Social Security. So Social Security takes out 6.2% of your gross pay. So if you're making $1,083, it's about $62, $63 in Social Security in the same amount of money. So while they would like you to believe there's an account there with your name on it, like a 401k plan, that's not the case. Your contributions go into general tax revenues, and they're used for general expenditures down in DC. So even though you get a statement with your benefit on it, all the money is commingled both for everybody else covered by Social Security and other government spending. So it's just another form of tax. So again, Social Security is 6.2%. Social Security tax stops when you get up around $110,000 a year. So if you make more than that, you will see the Social Security payment drop off, but your benefits stop too. So your benefit in Social Security is based on the number of years you worked and the earnings that you had. So you can only include in your earnings the amount of money that they're taking the tax out. So around $110,000. Medicare, which provides health care for older people, for seniors, is 1.45%. The employer also matches that. Unlike Social Security, Medicare keeps going. So it doesn't stop at $110,000. So if you make $500,000 a year, you're going to pay Medicare tax on the whole thing. So that's a flat tax as Social Security. You see the federal withholding there and the state withholding, and she has a medical plan. So she's not covered by any government plan, or her employer is offering her a medical plan. She is paying $42 every 2 weeks, $84 a month for the medical plan. So if you go, when you go to work, you'll have an opportunity to select probably from different medical plans at your employer. And she has a 401k plan. Okay, so 401k contributions come out in before tax dollars. So essentially you get a deduction for the money you're putting in the 401k plan, reduces your taxable income. So if you make $100,000 in a year and you put $1,000 in 401k plan, your taxable income becomes $99,000. It's a good deal. We are going to talk about that at the very end. Okay. So how do you go from gross to net? And you can see it. So she's paid $1,083, and they're going to take out 6.2% social, 1.45 Medicare, which is 765, 7.65% of her pay, which is a little over $70 plus $122 in federal withholding, another 42, so another $160 there, 42 medical and 76 401k. So she starts out with 1,083, and she winds up with quite a bit less than that. Okay, you see how you get there? Everybody's okay? You have no choice on Social Security. You have no choice on Medicare. You have some choice in the federal and state withholding. Your choice is whether you want it taken out during the year or whether you want to pay a larger amount at the end of the year. But again, you need to be at 90% of your estimated taxes.
What do people watching this think about all of this money being taken out for various withholding purposes? Is this something you knew about already? Is this different from what you expected? Do you feel that this is worthwhile to have things taken out for this? You can, put your thoughts maybe in the chat, or if you want to unmute yourself. This is definitely, for many people, they're very surprised to see that so much money is being taken out of their paycheck.
Could you repeat the rates they withhold each section, the federal and the state?
Well, the rate depends on really how much your estimated earnings are. It's a progressive tax system, and I'll show you a little bit more about that. But if you have a lot of income, the rate goes up as your income goes up. So I have an example. You'll see how the tax system works. But the withholding is designed to recover over the course of a year what your tax liability it will ultimately be. So if you make $100,000 a year and your tax bracket is 20%, then the withholding will be $20,000 divided by $12,000 or 12 months. And that will be your withholding tax.
There were two different questions people put in the chat. Do you want me to read them both at the same time or just one at a time?
If they're similar, read them, just summarize them.
Okay, I'll read them both now and you can answer them whatever way you feel best. One person wrote, what about the Family Leave Act? Isn't there a separate line item for that now? And the other person wrote, if Social Security is general expenditure, what do you consider as the long-term security of this public benefit if I was so lucky to receive this as an adult?
Okay, I'm not sure I can comment on the family leave. I know there is money coming out. It's not a significant amount of money, and the employer has to match that. So I forget the rate, but it's not a significant amount. It's not like the income tax. So it's not a good answer to your question, but it would look the same way. It would show up as a couple dollar deduction from your pay, and the employer would also send that money in there. The future of Social Security is, you read different information on it, and they study it, and I think the projection now is Social Security is solvent, so to speak, for another dozen or so years. But again, it's a general obligation of the government. the government made a commitment to you to pay you X amount of dollars, $1,000 a month in Social Security. So when this hypothetical trust fund disappears, which it will, then the government is just going to cut you a check. There is no trust fund. There is no money set aside for this. So it's Social Security is just an expenditure, like the military, like education, like general maintenance. It's just an expense. In a corporate pension plan, money needs to be set aside, which is separate and distinct from the assets of the corporation. So in the event of bankruptcy, that money cannot be touched by the creditors. That money belongs to participants in the plan. Social Security, they used to set the money aside, but the deficits got pretty large, and the Social Security at one time was running a surplus. So the people in Washington, the representatives said, let's put both of them together, Social Security and general obligations, and it'll make the deficit look better. So it was just cosmetics. So the other part of that question is Medicare. Medicare is running out quicker than Social Security. So Medicare is like 5 or 6 years. Again, Medicare is just like Social Security. It's an expense of the government. There's no money set aside. It's not an insurance company where you pay premiums to an insurance company. It's just money in, the pile of money goes into the government, and money out is, and this is just a piece of the money out. So I long term, I think if the government makes a commitment to pay you a benefit, they will pay the benefit. I think this maximum Social Security benefit is like $36,000 a year now. So for people making a lot of money, it's not a significant amount, but there are a lot of people that is their only source of income in retirement. So I think it's going to be there. So you can see what's going on here, and there was a tax reduction in 2017 or 2018, and what I did is compare them. Now this is we are a progressive tax system. So for example, Medicare is a flat tax. So that means whether you make $100,000 or $500,000, you pay the same tax rate. You're going to pay more in actual dollars in taxes, but the rate's the same. We have a progressive system. So the more you make, the rates go up and the dollars go up. So for example, here you can see the different brackets now and the standard deduction. And so at the first $9,500, it's 10% is your tax rate. So any money you make up to 9,500 is 10% less the deduction. Now, standard deduction is the amount you take from your gross earnings. So you can either itemize your deductions. If you have high interest payments, you give a lot of money to charity. You have a lot of other deductions, you wouldn't use the standard deduction. But part of the Tax Reform Act in 2018 was to make it more attractive and easier to use the standard deduction, because that amount would be greater than itemized deductions for most people in that salary range. So I have an example on the right, which shows how the system works. I'm working with my screen here, and I have your beautiful faces here, and I can't see my numbers. So, Harry, can you read those numbers for me, or
Sure. I can read that for you. So income of
Oh,
12.
I got it. I got it. Now I can't see your beautiful faces.
You can switch it back once you're done reading the number to the figure.
Okay, so if you make $12,000 and the standard deduction, you can see it over here, is $12,000, you're not going to pay any taxes. So the deduction is more than your tax liability. If your income is $50,000 and you use the standard deduction, that means your taxable income is $38,000, and your rate, you get some of the money at 10%, and the difference between 9,500 and 38,000 is taxed at 12%. So you see, as the income goes up, the rate goes up too. And then $100,000, $12,000 standard deduction, your taxable income is $88,000, and your rate again goes up. So it's not 12% all the way, it goes up. And that number continues to go up. I think the highest rate is in the area just under 30% now, and there's talk of raising it even higher than that. So if you're up in the $1 million bracket, you could be paying $300,000 in taxes. So it's a progressive system. Both the amount that you're paying and the rate that you're paying at goes up. Anybody questions on that?
I think, and stop me if you already answered this, but I think a common misconception that a lot of people have with this, the way the progressive tax rate works, so I'm going to pose it as a question. If you are on the edge of going from one of these tax brackets to another, so let's say you make $37,000 and you can get a raise for $2,000, that would bring you to $39,000. The idea a lot of people have is, does that mean that all of your income is taxed at that higher rate? And would that mean that I would be losing money from doing that? Yeah.
You would always have higher. Let's use $39,000. It's easier to work with the numbers over here. So on the you're making $39,000, you get $1,000 raise. Okay, so the first 39,000, you're going to pay 15% essentially. The next 1,000, you're going to pay 25%. So you're not paying 25% on the whole thing. You're only paying 25% on the difference, in this case, $1,000. So you're always better off taking the money. So because the money, the higher tax rates only apply to the money over the bracket. So it's not going back. It's not looking back at your money leading up to the bracket. It's looking at what you have after you went over the bracket. So take the money, put it in your pocket and say thank you. Okay? You okay there, everybody? All right, we're going to talk about credit and borrowing now. So I'll run through this part quickly. I think you understand this. We're using credit whenever we receive goods and services. So if you use a MasterCard to buy a Canada Goose jacket, you see a Canada Goose jacket up at Chestnut Hill, and absolutely positively want to have it. It costs you $800. You can either pay $800 in cash, or you can put it on your Visa card. When you put it on the Visa card, you are borrowing that money from Visa. They're lending you $800. You need to pay it back. So credit enables you to buy things, cars, homes, Canada Goose jackets. Most people don't walk around with $30,000 to buy a new car or $500,000 to buy a new home. So you borrow the money and you have to pay it back. And it also lets you pay for money. You're on a trip and your car breaks down and you need to get it fixed. You have a Visa card, you put it on the Visa card. They'll take care of the bill, and Visa guarantees the payment to the vendor, in this case, the garage. And he's, at that point, the garage is out of the transaction, and it's between you and Visa. Now, there are a lot of credit cards, if will let you back out of a transaction if there's some fraud involved there. Now, so there's a lot of good parts to credit, but I've seen a lot of people get in trouble, and they'll use a credit card and max it out, and they'll go out and get another credit card to pay off the first credit card. And you need to be really careful if you're living on the edge on credit. It gets harder and harder to pay it back. So credit, you can lose track of your spending. It assumes that you're going to have money in the future, and of course, overspending can lead to debt problems. Advantages and disadvantages of credit. Now, if we were doing this live, we would have polls in the class. We'll just kind of talk through them. So having a credit card can lead to more spending. Again, we talked about examples. You have a car problem, or you want to buy a Canada Goose jacket and you're willing to forego some income in the future to pay it off. That's fine. Provides purchasing flexibility, helps you out in an emergency, and we talked about that. Lets you make large purchases. Now, here's one that, and we'll spend a little bit more time talking about. When you use your Visa card, you are essentially borrowing money, and you will pay back more than the item cost, because Visa or the bank is lending you money and they want to get paid to let you use their money. Some debts can take a long time to repay. I think many of you are looking at college loans, and you know how difficult that can be, and what a prolonged period of time it is. Late payments can damage your credit history, absolutely. You need to, if you're going to use a credit card, you need to pay on time, at the very least, the minimum. And if you're on the internet, really the only way you can make internet, well, there's a couple ways, but the main way people make purchases on the internet is through the use of their credit card. So a couple examples of the ultimate cost of a loan there. So let's take a look at a $20,000 student loan. Now, a student loan is amortized. So when you pay money back, you're paying back the interest for that period of time, plus a piece of the principal. So you will make a steady payment over time. The interest portion of that will go down because your loan balance is going down as you repay it. And the principal balance, the principal part of your payment is going up. So it's a level payment. And at the end of that period of time, 10 years, say, you pay $200 a month or $240 a month, the loan is gone. You paid off both principal and interest. So if you look at a 10-year college loan at 8%, the credit price, what you're paying back is $29,000. What you borrow is $20,000. So the difference between $20,000, which you got, and $29,000, which you paid, is the interest rate. That's the charge the bank makes for lending you the money. So we'll look at another one. If you go buy your Canada Goose jacket, that's revolving credit. Okay, so what that means is that the amount of money that you're borrowing is not the same. The amount of money that you're borrowing goes up or down every month depending on your purchases. So you can spend $400 one month, $500 the next month, and you borrowed $900. When you pay it off, it goes down, it could be $200. So it's revolving credit. So you take your credit card, you use it, it adds to your balance. When you make a payment, it lowers the balance that you have. So most credit card interest rates are in the area of 20%. So if you borrow $500 to buy the Canada Goose jacket at 20% interest rate, you will pay $555 for that jacket. So that includes the cost of the jacket plus the cost of using someone else's money. So the $55.80 is the cost of using the money. Car loan is an amortized loan. Just give you an example, $10,000 for the car, paying $191 a month, and 5 years at 6%. Costs you $11,513 to buy that car, and with a sticker price of $10,000. And if you really absolutely positively have to have a condo in the South End, if you can find one for $1 million, so you take out a 30-year mortgage at 5%, it's amortized, you're paying $5,300 a month, and over 30 years, the amount that you pay, your total outflow, is almost twice what you borrowed. It's $1.9 million versus the $1 million you paid for the condo. Anybody have any questions on how that works, how loans work?
I have a quick question. Thank you for all the information, Edmund. This has been super valuable. I understand the amortization table, like, so let's just say the 30-year loan, at year 15, you're gonna reach that point where you're paying equal amounts of interest and principal. And then after that point, you're gonna be paying more in principal than interest. But in general, on a 30-year fixed rate mortgage, is it always double what you borrow? Like, or is that just, it's probably just based on the 5% interest rate?
It's the 5% that does, if it were 10%, the number would be a lot higher.
Sure, okay.
Still borrowing $1 million, your monthly payment would go up quite a bit.
Yeah.
Your term is still 30 years, your interest rate is 10%. You know, you can do the math, but you're probably going to pay close to $3 million.
Yeah, that's crazy. I mean, interest rates are lower now. So it's like, you know, around 3. So, you know, if you're, let's just divide that in half, like at 2.5%, you're paying, you know, like $1 million would be 15 or 1.5 million over the course of the 30-year if you paid on time without making prepayments or anything like that.
Yeah, it doesn't quite work out like that, but I think in principle, you're right.
Okay. And then, like, you know, it would be helpful in this chart would be like, you know, if you are borrowing that money, it's like, say you have, you know, say your outgoing payment, your monthly 30-year condo payment is $5,368. What the difference would be if you were able to pay $5,500, you know, like, or like, you know, how much $100 extra per month would work out in the long run, like to have that kind of table to see like, oh, well, if I do this, this will decrease the amount I'm paying for the loan X amount. So if I could pay $25 more versus $100 more per month versus whatever, like this is the end of the day cost benefit for me to be able to shell out that money in advance.
Yeah, you can do that. And I've done that on loans I've had before.
Yeah.
That extra $100 shortens the loan by a considerable amount because that extra $100 reduces your loan balance. It doesn't go on to the interest.
Mm-hmm.
So your loan balance starts to go down a lot quicker. And then when they recalculate the rate on the outstanding balance, that's going to start to come down. Not the rate, but the payments will start to come down quicker. It really, extra $100 a month on a 30-year loan would shorten that loan somewhere between 20 and 25 years.
That's crazy. Yeah.
It's amazing how quickly it works.
Yeah, because I think you could reach that midpoint in the amortization table where you end up paying more, because like the closer you get to that midpoint, the sooner you're paying more in principal than interest. So that kind of mitigates the amount of outgoing capital on your part for like, how much you're paying for the money you're borrowing.
Yeah, I don't think that you reach that point at exactly 15 years. I think it's
Okay.
longer to reach
Oh.
that midpoint.
Oh, okay.
Because it's just the way it works, because you're paying so much money, so
Up
little
front.
principal is coming down in the first few years.
Yeah.
And then as you get to the end, what you're paying back is mostly principal.
Yeah.
So the bulk of your principal
yeah.
repayments are occurring in the second half of the loan.
I will also just add, although maybe getting an apartment in the South End is not the most financially judicious decision to make, in general, mortgages typically tend to be a better value than renting because you are paying to eventually own the place, which at that point, of course, you don't have to pay anything anymore. And often mortgage payments can be lower monthly payments than rent payments would be. The issue is most of the time mortgage payments need some kind of down payment, which can be thousands or even tens of thousands of dollars.
Yeah, now, the government does subsidize homeowners. It doesn't subsidize renters. So you deduct the interest on your mortgage. So you don't deduct the entire payment, but any interest you pay on your mortgage really reduces your out-of-pocket costs. So if you're paying $5,000 a month and you're in, let's just say a 10% bracket, then the first 500, you deduct that from your taxable income. That's a deduction.
I'll also add on that, that is the case on the federal level. On the state level, since in my opinion, at least Massachusetts is a pretty cool state, they do let you deduct payments made towards rent.
Yeah.
That's something that I did myself when I filed my taxes earlier this month. So if you do rent an apartment, you can deduct that to some degree from your state tax, what you have due.
So if you really want to get into it, every once in a while I teach a principles of finance course here too. And we spend a lot of time talking about different loans and payments and amortization schedules. This is a nice little video that talks about the cost of credit. So hopefully you can all hear it.
Great pizza. Is it worth $2,000? Huh?
I didn't say anything.
I did. Who are you? I'm the credit card you just used to pay for that $2,000 pizza. What are you talking about? It only costs $9.95. Yes, if you paid it off within the grace period. But you only pay the minimum due. And you've almost maxed out your $500 credit limit, mostly on pizza and other impulse purchases. So, if you just keep paying the minimum, it will take you 267 months to pay me off. And all those little charges will wind up costing you $2,129 based on an 18.9 annual percentage rate.
We better enjoy this pizza. You'll be paying for it for 22 years.
I wouldn't talk if I were you.
Who's that?
Uh-oh. That's my credit card.
That's right. And you owe about $3,000 on me.
That's not so bad, is it?
No, except you only make the minimum payments too. That means you'll be paying for that smartwatch about 2 decades after it's gone out of style. By then, that $3,000 balance will have cost you $12,774 based on your annual percentage rate, which is also 18.9%.
So you're saying we shouldn't use credit? Oh, not at all. Credit cards are a powerful tool when you let them work for you.
Credit cards are handy and safe for online purchases, and we can be a lifesaver in an emergency. We help you establish the good credit that will help you purchase important things like a car or home.
Use credit within your budget. Try to stay away from impulse purchases, like food.
And clothes?
It's fine to use us for a special celebration.
Or to buy a suit for an important interview.
But remember to think before you spend and stay within your budget.
Here are some simple guidelines for managing your credit.
It's okay to have credit cards, but manage them responsibly.
And you really need to pay your bills on time.
Keep your balances low on credit cards and other revolving credit.
Pay off debt rather than moving it around to other credit cards.
Don't open a lot of new accounts too rapidly.
And finally, check your credit report often
Remember, keep your credit working for you.
and not the other way around.
Okay, so just a little vignette there. I'm wondering, as I look at this, probably if you left the pepperoni off, you'd only be paying that off over about 10, 12 years, as opposed to 20 years. So again, credit is a great thing, but you need to be really, really careful with it. You need to keep it under control. Now we'll talk a little bit about credit rating. So who gets to borrow money? And we've got a couple scenarios here again. And then, just mentally put a check mark is in the yes or the no as we go through this. So pay telephone bill on time. Is that a good thing? Yeah, that improves your credit rating. Okay. Do you have a savings account? You have money in the bank you can use as collateral. And in the event you default on the loan, they'll come and they'll take that money. But if you have collateral, it really improves your chances of getting a loan. How about if you're unemployed? So you have no assets and no source of income. I don't think the bank's going to be rushing out to loan you money. No credit history, which a lot of you in college will not have a meaningful credit history. And we'll talk a little bit about that, but it's to your advantage to create a credit history while you're in college, as long as you can control the amount you're borrowing and your payments. Do you own something of value or nothing of value? Again, if you own something of value, that's collateral. If you own nothing of value, then they're only relying on your income to pay off the loan. When they look at your credit report, if you have a history of late payments, say, for example, the cable payments, then that works against you. And if you're sharing an apartment with two roommates and out of the goodness of your heart, you put your name on a cable bill, you're responsible for it, irrespective of whether your roommates are there and they help you out or not. If your name is on the bill, you're responsible for the payments. And then the next one is, have you been in the same job for a while? And the answer, if that's yes, then you have a consistent source of income and they consider you a better credit risk. So you can check your credit rating and we would advise you to do that. So they look at the probability of repaying a loan they call a FICO score. And the scores range anywhere from 300 to 850. If you're up in the $600, $700 range, that's considered a good credit rating. And you can buy a car on that. Even if you go buy a house, if it's not too large.
Oh, Edmund, sorry to interrupt. We did get another question in the chat. The question is, should I put my name on the bill? Does it improve my score?
If that has a plus and a minus. I think paying bills on time helps you. If your roommates skip out or they're late in their payments or they're not as diligent as you are, then having your name on there hurts you. So at this stage of the game, I think if somebody else is willing to put his name on the bill and you're willing to reimburse me, or I think I would go that way and get a credit card, get a Visa card, and go out and spend $20, $25 a month on your Visa card. That definitely helps. And you're managing your own money, you're managing your own credit score at that point. So here's a couple of websites, and I asked Ari to send these out. So you can go to any of these and you're entitled to a free credit report. And you can go to those sites. And the one that people use a lot now is Credit Karma, which is a good one. You punch in your information and they'll give you your FICO score. And that's what you need to see where you are. And there's some things in there that might surprise you. You might have been delinquent on something, a minor bill a couple of years ago, and it become obvious and you need to just clean it up. So this information is out there. You should access it, make use of it, and manage it. It's something that you can manage, and it's within your control to manage. Tips to build credit, open one bank card. So this is what we talked about. Go out and get a Visa card. You can put a maximum amount on it and pay it off every month. So that's the best thing. Don't buy anything that you can't pay off. You don't want to start building up balances in a revolving credit card. Avoid specialty cards. So don't go to Bloomingdale's and take out a Bloomingdale's card, and Home Depot and take out a Home Depot card. And it's easy to lose track of what you're spending, and it's difficult to drop the cards later on. So you're better off with a Visa or a MasterCard or something along those lines than multiple cards issued by multiple vendors. If you have a student loan, you should be in good standing. That helps. Talk about your credit rating. Pay your bills on time. Pay that cable bill. Don't miss payments. If you're late on payments, it shows up on your credit report. And if you have a credit limit, let's say $1,000, don't keep bouncing around $980, $990, because at some point you're going to bump up against the maximum limit. So come in under that, spend what you can repay at the end of the month, and that will help you get a good credit rating. So there's a chart here, and it looks at how you can improve or hurt your credit rating. And you can see the ones that are green, very low risk. That means they help your credit rating. So pay your bills on time, use small portion credit limits, use a diverse range of loan products. So you may have a car loan and a Visa credit card. So if you inquire about a new loan but don't actually get it, it has a minimal impact on your score. If you open a new loan, well, the question in their mind is, why do you need that? Why are you doing that? And then if you have multiple new accounts, again, it's a minimal, almost insignificant drop in your credit score. Now, what can hurt you is max out your credit card, and we talked about that. Pay late, especially your first payment. Pays multiple loans late, larger drop. Misses multiple payments. Now you're getting into a lot of trouble. If they have to charge off a loan, or if there's a foreclosure. So if you have a house and there's a foreclosure, really impact. Or you go bankrupt. In the event you go bankrupt, your creditors are probably not going to get 100 cents on the dollar. So there's good things you can do to improve your credit score, and then there's some danger areas here you need to pay attention to.
We had another question in the chat about some of the content on this slide.
Yeah.
The question is, could you elaborate upon the difference between exposure and normal expansion?
No, the exposure, it's just a question on the creditor's mind. Okay, am I increasing my exposure with this individual because they want more credit, or is the individual making more money and they just normally want to expand their credit limits? So it's a question of exposure. So by getting more credit, am I reducing the likelihood or increasing the likelihood I'm not going to get my money back? So if you have a credit card, a Visa card, and you go out and you get a MasterCard. So then the question is, why are you doing that? And the lender would have to say, okay, is that normal? Or am I going to get in trouble because he's increased my exposure? So now I have 2 credit cards with $1,000 limit on them, as opposed to 1 credit card with $1,000 limit. So if you put yourself in the shoes of the lender, the credit card issuer, then I think the answers become pretty much self-explanatory. Their business is to manage risk. Their business is to minimize the amount of loans that go into default. Okay? That makes sense? Okay, if there's a problem, if you have trouble getting credit, or you get a credit report and something shows up, then some steps you should take is contact the credit bureau. So there are different credit bureaus that will send out the reports. You should contact them and understand the nature of the problem. They will tell you what they need to resolve it. So those are the people that publish the credit scores, the credit report. You can also work directly with the lender. So you go out, buy a new Chevy, you can work directly with GMAC or whoever the financier is to resolve the situation. You can file an addendum with the credit rating agency, explain your side of the story. So you are entitled to do that. Maybe there's a logical explanation for what happened, and it will probably mitigate the damage. If you're in a problem situation and you have credit cards with high interest rates, and typical interest rates for credit cards are in the area of 18 to 20, 24%. So if you have $1,000 at a 24% rate and $1,000 at an 18% rate, get rid of the one at the 24% interest rate first. It lowers your monthly payments. Okay. And if you're in a problem, and this happens a lot, and I'm sure a lot of this is going on right now with COVID problems, and businesses, you can try to negotiate lower payments. So I know a lot of small businesses negotiate with the landlords to get some forbearance or to negotiate lower payments. You can do the same thing. So you can talk to GMAC and just say, look, I've got a real problem here. I had to change jobs, and I'm okay paying $500 a month instead of $700 a month. You can also talk to your family, and you can talk at BC, talk to the Successful Start people or the credit service and see if they can help you out here. This is the Wall Street Journal did a couple of really good articles designed for people of your age. And they say, your parents gave you financial advice. Is their advice still relevant? So the first one, they talk about the cost of college there. And you can see how much the cost of tuition went up. And I hate to tell you, but when I got out of BC first time in 1970, and 4 years of room, board, and tuition cost $10,000, $2,500 a year. When I graduated, you could get a job for $10,000, $12,000 a year. So your income from the first job covered an entire year's worth of tuition. So you need to be really, really careful about college and college loans, and really, maximize your grants as much as possible. And in some cases, you really have to ask yourself, is it worth it? And I think at these prices, and whether it's BC or some of the other really good schools, there are other ways to get there, which may not involve as much debt. So, for example, you go to community college for a year, go to community college for 2 years. So you need to look at where you are and where you expect to be. It's a lot different paying off $200,000, $300,000 in college loans than it was in my time, where it'd be $10,000. So you need to be smart, and a college loan is borrowing money. And you can see that. You see that student loans are about $1.5 trillion now. So you also ought to think about different ways if you want to get a master's degree. And maybe you don't want to jump right into college to get a master's degree. If you go to work for a major company, most companies will reimburse your tuition. So if you want to get an MBA, maybe you graduate from BC, you go to work for a year or 2 years, and then go get your MBA at night and have your employer pay for it. So there are different ways of getting to the same place. And there's questions about homes, and you see what's going on in Boston. The high-end condo market is drying up. So maybe if you want a high-end condo, it's a good time to buy one. But do you really need a home? And we talked a little bit about this, or are you okay renting? And well, what about location? Well, you see a lot of people now moving out of some of the large cities, New York, San Francisco, and they're moving to places where there's a lower cost of housing and maybe a better quality of life. So you may want to look at places that you haven't looked at before. So there's an exodus of tech people out of San Francisco, and they're going to Utah or Idaho or Denver, which is starting to get very pricey. But if you're flexible, you can save a lot of money. And the question is, how much of your income do you want to spend on a place to live? Be smart with your spending, and I'm going to talk about the match on a 401k plan. And make sure when you do your budget that you allow some money for some fun. So you want to allow some money to go out, have a couple of beers on a Friday night when people are allowed out to have beers on a Friday night. So I left, there's a good article, and I think you have a copy of the presentation. It just reiterates a lot of what we talked about today. And there's links here to the Wall Street Journal series, and they're a good read. You really ought to go out and get it. If you subscribe to the Journal, you'll get these articles at the link. If you don't subscribe to the Journal and the Wall Street Journal, and you have an interest in finance or financial matters, you can get an electronic version of the Journal for free as long as you're a college student. I think if you contact the library, they'll tell you how to go about doing that. So if you have any interest at all in pursuing finance or really in dramatically enhancing your financial literacy, I would recommend that you take advantage of the journal, offering get an e-version of the journal. Okay, we're getting to the end, and I want to talk a little bit about 401k plans. So when you sign up for a job, you leave here and you sign up and you get a nice job, $50,000, $60,000 a year, you're going to have some decisions to make. So they will give you a withholding form. They're going to ask you how much withholding should you take out. And they give you a worksheet to help you decide. But generally, somebody in your situation will take either zero dependents, which means you're gonna pay more money throughout the year and get less back at tax time when you pay your taxes, or one dependent, you will get a little bit more money on a monthly basis and get a tax refund, a lower tax refund. Some people like to use the tax system to get a refund come March or April after they file their taxes. I don't advise you to do that because you're lending the government money and not charging them interest on it. So generally what I advise people to do is make your withholding as close to your estimated taxes as possible. You will also, they will give you forms to pick a health plan, and health plans can range from very expensive to minimal. You can get a high deductible health plan, and that the cost of it on a monthly basis is not that significant. Or you can get a high cost plan where it has a low deductible and the insurance company pays more. So if the insurance company is paying more of the benefit, you're going to have a higher premium. If the insurance company is paying less of the benefit, you're going to have a lower premium. You need to decide based on your own perspective and your own health, how much of that do you want to offload on the insurance company and how much you want to pay yourself. But I do want to spend a couple of minutes on the 401k plan. If you're making $50,000 in salary and you contribute $5,000 a year, you only have $45,000 in taxable income. So your taxes, assuming 10% tax rate, go from $5,000 to $4,500. So the government is subsidizing. They want you to put money in your 401k plan. You pay tax when you start to take the money out. So you don't pay tax while you're putting it in, you get the deduction. But when you're 65 or 70 and you start taking the money out, then you need to pay tax on both the contributions and also the investment earnings. What I advise people to do, most plans today and most companies you will go to work for have a match in their 401k plan. So what does that mean? So typically what a 401k plan will say is, again, using $50,000 in salary, that if you put in 6% of your pay, and you can put an amount lower than that, but a maximum of 6%, in other words, $3,000, we will match 50% of the money you put aside. So if you're putting aside $3,000, the company will contribute an additional $1,500. So instead of $3,000 going into your 401k account, you have $4,500 going into your 401k account. That benefit is enormous. So you're getting a 50% return on your money on day one. So it's really important that you do that. If there is a match, work yourself up to where you're contributing to the point, the maximum point where they're going to match. So some people might start at 1%, and they will match. If 1% is $1,000, they'll match $500, and then up to the 6% match. And you want to get yourself up to that point, to 6%. and have them put the maximum in. That becomes your money after a relatively short period of time, like typically 3 to 5 years. So the most important thing you have going for you as an individual who will be paying for your own retirement is time. So, and it's really important when you get settled and you go through your budget is to try to find some money to go in your 401k plan and keep putting that money in there. A lot of people will put the money in there at say 2% in the first year. They get a 3% pay raise the next year, they'll put another 1% in. So every year when they get a raise, they'll increase the amount they're putting in. So this is just an illustration of how important time is. And time is based on principles of compound interest. And as Einstein once said, the most important force in the world is compound interest. So here we have somebody putting in $5,000 a year, and you can see the orange kind of line, and where they start is obviously 0. They start putting it in at 25, and they start taking it out at the end of 40 years. By putting in $5,000 a month at 5% interest, they will have put in $200,000 in contributions and taken out $600,000. So the amount of money, the amount of time compounds those account balances enormously. And you have to get in early and you have to keep it in there, and then you'll have a pretty good amount of money when you retire. A couple other ones that I show you, the kind of the reddish brown and the gray line underneath it. So this says, okay, well, I'm going to have a good time until I'm 45 and then start saving. That's fine. That has enormous consequence. So you have 20 years of earnings in there. So you start at 20 and you go to, or start at 45 and you go to 65, and you can see that reddish brown line there. So you will put in about $160,000. You'll take out $200,000. So your earnings on that money, because you're only talking 20 years instead of 40 years, is still have a return of $40,000, not nearly as significant as the first one where you put in 200,000 and you took out 600,000. It's a multiple of 3 times. Okay. The last one says, well, I'm really going to have a good time, and I'm not going to put money in there until I'm 55. So you can see that there's very little difference between the two lines, the dark gray and the light gray. Maybe $10,000 difference at 5%. So 10 years, you put in $50,000, maybe you're going to take out $65,000. Time is the most important thing you have going for you in a 401k plan. Take advantage of it. Take advantage of the math on it. And if you're not comfortable with investments, they even have investment options where the plan will, most likely Fidelity will be the provider. Fidelity will manage the money for you. So that's my suggestion. Get in, put in as much money as you can, as early as you can. Put your money in, they call them target date funds. Let Fidelity manage money till you get your feet wet, or at the very least until you go to the next class where we start talking about investments. So I think that brings it to close. Hopefully this was beneficial to you. Are there any questions out there, Ari?
Not written in the chat, but I think that's a good time to ask. I know we went over a little bit, so if you have to leave, that's understandable. But for anyone that is able to stay, if you have any questions on anything we covered, feel free to unmute yourself or put it in the chat, and we can be sure that gets answered. We'll just wait a few more seconds to see if anything comes up.
Thank you so much for your time. It was a lot of information and very helpful, and really appreciate you guys going over all these. questions and giving all the information.
Yeah,
Thank you.
yeah. If you have any questions, I mean, you can send them in and we'll try to get back to you with an answer. Any outstanding questions?
I'm going to put our email address in the chat. So if anything comes up later, you can do that. You can email us. And like Edmund mentioned, this is typically part 1 of 3, where we would typically cover 2 more presentations on investing and financial planning. And we're going to talk to see about getting that potentially scheduled. But please do check out our website where we do have other presentations coming up in a few weeks. We have one with a presenter from the Career Center talking about negotiating a job offer. So that might be something that's helpful for you as well. Any last questions before we wrap up for the evening? All right, great. Well, in that case, thank you everyone for coming.
All right, very good. Thank you very much for coming.
Thank you.
Bye-bye.